we might start things off and go from there. So let me, without further ado, just start off, and for people who don't know us, I'll just give a brief introduction to who we are and what we do. But for some of you who obviously do know us, please bear with that. It's an interesting time because the RBA just met yesterday, and we'll go through that and I'll give you my thoughts on what's happening in the land of Oz. So this is the August quarterly review. Obviously there's a disclaimer there. It's all general information and not designed to be individual or specific financial advice of any kind. If people want that, of course, they can avail themselves of that. That's the structure of the various businesses that we have, and I'm sure a lot of our Australian expat clients will be quite well familiar with Wise Guru. That's our international consulting business that helps Australian expats around the globe with financial matters, I suppose, that relate to buying properties, financing those, perhaps refinancing existing ones. We have Unicorp Partners, which is our financial advisory business in Australia, and deals with financial matters, superannuation, risk management, etc. Aussie Loan Guru, again, most people would know about that, is our niche mortgage lending provider that specialises in the medical professions and in Australian expats all around the world. And Aussie Property Guru is our property real estate business that's based in Australia. So we'll go through, I suppose, what most of our clients are, and most of them earn higher incomes, they're time poor, they want to build their asset base in an affordable and tax efficient manner. Many of them want to buy property in Australia because it's something that's an addition to, I suppose, their portfolio from a growth asset viewpoint, and something that's diversifying away from equities. And they want to make better informed choices. They want those to be researched, and because they're so time poor, they can't do that themselves. So that's where we developed our concierge service, and that's where we can assist people in helping them through that process, tying it all together, putting them in touch with a range of professionals to assist them with that whole process of perhaps profiling a property, going through the actual situation of purchasing that, then looking at how they're going to rent it out, and it's like an end-to-end solution, I suppose, that helps people a lot of time and money, and we've had a very good feedback to that over the years. So it's interesting that this one is very similar to the last one, where most people are still asking about interest rates, and I'll go through why afterwards. But however, then on the other hand, now it's been, when will the RBA raise interest rates? And some of them are very frightened of that, of course, and saying, should we fix our interest rates now? So it's one of those scenarios where there's a lot of angst out there, and people don't know what to do. In fact, over as little as perhaps a week or two ago, there were a lot of people who were wanting to talk the RBA up almost to raise rates, and nearly, I guess, perhaps succeeded, but the events of the last few days have certainly changed that. And when Australia came out with the latest CPI print, the RBA left things on hold. The other questions relate to, how are these interest rates, these higher interest rates, going to impact property prices? And the other question is, look, one good thing that most people are finding is that rents have been increasing, but, will that continue? And a lot of people are actually looking, and they're in a position to be able to purchase something. So they're saying, where are the good places to do so? And we always look at the underlying drivers there to see what's going to be, I suppose, beneficial for people in the longer term. So it's an interesting point, but why is Australia talking about rate hikes when the rest of the world's talking about rate cuts? And you've looked at other central banks in developed nations now, not cascading, but certainly starting to reduce their official cash rates. So why should Australia be so different? And if you look at that graph on the right, you can see that the debt servicing ratio in Australia is second only to Norway. So because Australia has a unique situation where virtually everyone is on a floating variable rate mortgage, these higher rates have been passed through very quickly, whereas consumers in the US are on the other end of the scale. A lot of them have 30-year loans and they fix those at low rates and aren't feeling that problem. But if you look on the left-hand side, and I often speak to people about this, if we continue, when I say we, if the Reserve Bank of Australia continues to raise rates, it is giving a benefit generally to the older cohort that has, that has more cash in the bank or cash on deposit in their super funds, term deposits, and other instruments that are benefiting from higher interest rates, because the banks will be passing that on to their retail clients in some form. And these people then have the ability to spend more money, which is something we've been seeing over the last 3 or 4 quarters. And if we look at the top contributors to Australian services inflation, which is what gets spoken about all the time in terms of the stickiness of that and how that's been increasing and lingering, well, if you have a look for the last, the latest figures, international holiday travel and accommodation is by far and away the highest. And then we sort of delve into that and look at who's spending that money, and it's people over 65 that are the biggest group there again. So it all ties together, and raising the official cash rate may not necessarily bring down some of the stickiness in our services inflation, because the second one is domestic holiday and travel, and then rents. So there are issues there everywhere, I suppose, and it's something that we need to address. Here's just a very quick reminder to all of our Australian expat clients around the world that nothing changed in this year's budget, that the current situation in relation to tax residents remains as it is, and many people often get this confused. There's a lot of confusion, people saying, oh, but you can't spend more than 45 days in Australia now. Well, that's actually not correct, and nothing's changed. But if anyone wants some more information on that, by all means, please get in touch. One of the things that most people, whether they know us or not, understand is that we look at Australia and look at, I guess, the vastness of the continent, just to underpin how research is really important, because the markets around the country vary so much. So we use the national service providers for statistics, the ABS obviously, government agencies, Urbis, CoreLogic, Resolution Research, etc. But then we put our own overlay on that. So if we have a look at this here now, the interest rate scenario, the RBA board met yesterday, so pretty current data here, and they decided to leave the cash rate on hold at 4.35%. The last rate rise was in November last year. So if you look at their statement of monetary policy, and again, we could send that to anyone that desires it, but the bottom line is, they recognise that inflation is still too high because demand is too strong. And I've just been through a lot of those demand factors. Economic growth they expect to pick up next year, and they see the labour market continuing to ease gradually but to remain tight. So overall, inflation is expected to take longer to return to their target band between 2 and 3%, and risks remain, as I say, to the upside as well as the downside. But in my view, employment will be the key to this, because it'll all revolve around jobs and employment remaining strong. But if you have a look at the inflation forecast that the Reserve Bank has here, they look at trimmed mean inflation. You can see that line, the darker line, gradually decreasing and coming into the band at the end of next year and then going further down. At the same time, CPI, as you can see, bounces around a bit more, and they see that increasing towards the end of next year and then coming down. So don't be frightened of, I suppose, this is something we need people to understand, the quarterly and monthly CPI prints and underlying data, because the bank looks at things in a slightly more longer term and holistic manner. I still think that we will see a reduction in rates, and that should happen definitely, I believe, in the December quarter. So if you're a borrower, if you've got a mortgage or investment loan, rates have been pretty steady for us in the last few months, and certainly been high. It's a situation that most of our clients are now starting to feel the pinch of these rates being at current levels, because many of them are between 6 and 7%, depending on what sort of loan it is and which lender you're with, etc. But it is challenging for most investors. So that then leads on to what's been happening in relation to how do people cope with this, and how do property prices still keep rising? So how property values continuing to rise with these higher rates. And if you have a look at this, it's interesting. You can see on the left hand side, the purchase value, pardon me, the affordability has continued to decline sharply over the last year, and yet median house prices have risen sharply, and median unit values have risen more modestly. However, people are still looking and being able to make these purchases, and median values are only a statistical sort of, if you like, line, as it were, and we all know that people are buying homes that are quite expensive. But I think that's because people with more cash are coming into the market. So wealthier buyers have got there with higher deposits. Other people are buying in cheaper markets. Apartments are becoming far more popular, and we're starting to see the prices of those actually outperform detached dwellings, and that's again, I think, due to affordability and the wealth transfer effect, inheritances, parents and grandparents. That's a massive amount of money that's starting to filter through demographics and assisting people to spend more money than would otherwise be possible. Then you have, if you like, perhaps two young professionals, or a young professional that wants to live somewhere, can't afford to buy it, but they're buying an investment property and renting where they do wish to live. And there are a lot of debt-free purchases. We're seeing that especially in the higher quality investment areas of high quality apartments, where downsizers who bought their house 30 or 35 years ago are selling that and being able to purchase something that they actually want to live in, and paying cash for that and having money left over, because there have been very strong gains made through not just COVID, it's been over the last 5 years basically. So pretty important to look at that, because it impacts what the markets do. Now, here are the latest forecasts from Westpac out to 25 about cash rates, bond rates, FX, and as I said, we've been saying this from all year, basically year to date, that we think there will be a rate cut in the December quarter. I think November potentially. Westpac is of the same opinion, and they see rates, as we can see there, then coming down during the course of next year. So December of next year, we're 1.25, 125 basis points lower. There are various, obviously, economists and banks all have their own view on this, but I think this is a pretty realistic one. And I think I'd remind people that things happen differently to what most people predict. So if you saw what happened in the last few days in global equity markets, bond markets, interest rate markets, currencies, when something goes awry, when things turn pear-shaped, things change very quickly. And if you look back 2 or 3 weeks ago, the financial markets, were pricing in very modest cuts from the Fed, and now they're pricing in basically 150 basis points of cuts before the end of this year. So, and there's talk around of the markets wanting the Fed to step in and make a cut out of cycle. I think that's being a bit too dramatic. But when things change, and this is what I look at in the Australian economy too, when things change there, i.e. from an employment viewpoint, things can change really rapidly in terms of how central banks will then potentially come in and try and rescue that situation. Generally speaking, because they've left things too long, as is now being said about the Fed. Anyway, time will tell, but we'll see what happens there. So if we look at that, and the other thing that's obviously important from our Australian expat viewers' viewpoints is the exchange rate. So that's been bouncing around, reached a recent high just under 68 cents to the US dollar, back down to 65. I think at these sort of levels, it gives a lot of our expat viewers a really great opportunity to invest in Australian assets and utilise the benefit of their employment earnings, which are in other currencies, especially if it's say US dollars or euros, Hong Kong dollars, etc. This is something that's from Coolback Capital, and it just looks at housing prices around the world, and I think it's important for Australians to recognise this too, that we're not, we don't stand out as like a sore thumb. A lot of people are always saying to me, oh gosh, Sydney's so expensive, how do people afford it? Well, spare a thought for people in other countries because they're going through the same thing. And it's important to recognise that, because I think what's happening in terms of that demographic shift of capital as grandparents and parents pass money down to their families is occurring in many developed nations. And others as well, of course. So, that's something that happens. Now, this last point, this is from Coolwell, saying this raises the question of whether some households believe interest rate cuts are not far away, and or more importantly, if monetary policy is not sufficiently tight. Well, I'm in the camp that believes that monetary policy probably is sufficiently tight, as I've said before, for those very important reasons. And it's really the case that some people are in a very fortunate position where they continue to earn high incomes and they simply can afford to buy the sort of assets that they're speaking about. So I don't think any of this has been prefaced on people expecting interest rates to come down very quickly in Australia, even though in due course that may happen. So let's look at some of the drivers of this, and most people will understand and recognise that Australia's had a massive bump in population growth. It's been a political issue that's occupied many of the news articles and newspapers. And last year, there was 651,200 people that the Australian population grew by. That's a big number, 2.5%, and they're the latest ABS figures to the end of December. You can see there, a record of people came into the country, over 751,000. That was a 15% increase on the previous year. And there was a decrease of 7.3% of people who left the country, 204,000. So very interesting. That has clearly peaked. And there was a lot of talk from the government and the opposition about how they're going to limit overseas migration, etc. That seems to have gone in recent weeks, but look, that's obviously still on the agenda. So that huge bounce has peaked, but population growth, I believe, is still going to remain very strong for Australia, and I can see that continuing on, certainly in the medium term. So if we look at state and territory population growth, again, that latest ABS data just shows us how, there is a great deal of discrepancy between the various states, and WA has certainly been leading that in the last couple of quarters. So 3.3% growth over the last year's latest numbers, and that's followed by Victoria, which grew by 2.8%. That all happened in the last, basically 12 months or so, and I think a lot of it's due to overseas students returning, because Melbourne's always been very good at marketing their educational institutions. And Queensland grew by 2.6%. I'll go through that a little bit later, because that's made up of more interstate migration than the other states. Let me just... Now, interestingly enough, even though rates are high, the value of home lending has risen really strongly, fastest pace since February 21. You can see that there in the left-hand slide. If you have a look at that uptick for both owner-occupiers, investors, and then there's been just a little blip down, easing in May there. But overall, and you can look at the slide on the right, investor lending is now very strong, representing just over 37% of all new financing. So interesting to see that, and again, it makes people have to think that many people can still afford paying the interest rates that currently exist. What we also look at, and certainly what APRA looks at and the banks take pay very close attention to, is the riskier types of lending, as they call them. And where we've seen, overall this is still looking really good, remains historically low. But what we're seeing now, if you have a look at that bottom left-hand slide, is you can see that the amount of interest-only loans is starting to increase. And that is because, I believe, obviously, of these higher interest rates. So people are trying to manage their cash flows, their monthly payments, and obviously if they're paying interest only rather than principal and interest, that's going to assist them in doing that. The other change here, if we have a look at, the amount of loans that were originated at a higher LVR, so above 90%, has increased. So that simply means that people are looking to purchase something, they want to buy something, they're short on deposit, so they're prepared to pay LMI, or lender's mortgage insurance, if they can get it, to make that purchase. But overall, if you have a look at the middle there, percentage of loans originated with a debt-to-income ratio greater than 6, or loan-to-income ratio greater than 6, remain historically low. So let's look at property as an asset class. I mean, it is one of the largest growth asset classes on the globe. And in Australia, it's extremely important. We're $10.8 trillion is the value of residential real estate in Australia. And the outstanding debt against that, the mortgage debt's only 2.3 trillion. So as you can see, about 20% or less. And that's something that many people forget, especially all the people that have mortgages, because they think everyone has a mortgage. But in fact, less than a third of Australians actually do have one. So something to always keep our minds open to. If we look at national home values, they've still grown very strongly, 8% over the last year, but clearly that's come down from a recent high of 9.6% to the end of February, and that's terrific, I think, because we can't have values increasing at extraordinary rates all of the time, because nobody will be able to afford to enter the market. But let's have a look at some of the other things and dissect where this is happening, and how the market, I suppose, is changing to some extent too, because the smaller capitals, so Brisbane, Adelaide, Perth, have been showing the strongest demand and the strongest growth. But what's been popping out over this year especially, and starting to show its head now, is that the style of dwellings, i.e. freestanding homes, have now risen less than units. And I think the reason for that is obviously price. So as houses have grown in value over the last 2 years especially, the value of those assets has grown to such an extent that now apartments are catching up, because people are saying, well, I can't afford to buy that house. I'll buy that apartment and I'll buy it in an area that I want to live in. So things to look at, and if you have a look at the various cities, capital cities here and regions, look at the bottom there. Perth, as you can see, Perth, Adelaide and Brisbane are charging ahead, and Melbourne's probably been the standout because it's actually gone backwards in the last quarter, and that seems to have accelerated. So we'll come to that again. One of the other areas we look at is, what's the value segment in the various property markets that's performing. And if you look again at that, Brisbane, Adelaide, Perth property market situation, all the value segments have increased. The lowest quartile being the strongest, and again, probably being driven by affordability. But interestingly, even the upper quartile has still grown very strongly everywhere, except really Melbourne and Hobart. So yeah, very, very interesting to see. And a lot of it is based on supply and demand, as with virtually any commodity or asset. So that's where population growth again is so important, and where is that going? Who are the types of people that are moving there? Are they fresh immigrants from overseas? Are they people that are moving from interstate within Australia? Because that's pretty important. But look, we look at the monthly dwelling approvals, obviously, but they bounce around quite a great deal. If you have a look at that graph, and I think what's really important there, especially in the apartment market, we've never really seen this level of underproduction, and that's being driven by high interest rates, higher land values, much higher construction costs, and the inability for builders to be able to to find labour to actually build these apartment buildings. So we don't see that changing anytime soon, unfortunately, even though the government is trying to say they're going to assist and other measures being taken. The bottom line remains that that's really challenged. And because of that, I guess what you've got to look at on the other side is that from an ongoing viewpoint, there are some pretty good tailwinds or strong tailwinds in so far as people who own assets or are acquiring assets from a medium-term viewpoint, that this imbalance is going to continue. The rental market's another issue, especially for people who are looking for accommodation. Rental markets are very tight. Rents have risen very strongly, and as we saw earlier in the presentation, the cost of rents is a key contributor, third highest, to that services inflation. And unfortunately, it doesn't look like it's going to go away until we do have interest rates coming down, because people who own these properties are obviously passing on as much as they can of the increased cost of servicing debt against that by increasing the rents, and people are having to pay it because there just isn't enough supply. So fortunately, you look at that and you say annual rent growth has eased. However, some of that is due to capital values of those assets increasing as well. So if you have a look at Perth, the annual change in interest rates, that look at the bottom right here, 13.2%. That's certainly high, and Sydney at 7.9%. So most of the capitals around the 8% mark. That's pretty high. That's a problem for a lot of people trying to find somewhere to live, and we've got to look at that, and hopefully that will ease or stay at current levels for some time to let people accommodate that, I suppose. So gross rent yields have been pretty steady for a little while now, hovering around that 3.7% mark, but that's probably going to compress a bit further in the next few months as the pace of capital gains is slightly higher than the gains in monthly rents. And again, there's a great deal of dispersion there if you have a look at the different regions and the different actual cities, which we do. And most people who live somewhere will recognise that from, you know, what's happening in their particular neck of the woods. So what do we do with all the data? How do we use the research? Well, first of all, it's important to recognise that, you know, there is no Aussie property market, and I get this especially internationally, you know, where people say that, you know, oh, what's happening to the Aussie property market? So pretty important to recognise that that is not a thing. There is no such entity. But what we look at also is what else is changing or has changed, and what people want has changed since COVID and continue to do so, I suppose, and is now evolving even, you know, further. So people want larger properties, you know, more space. Work from home space is really important. You know, a lot of people utilising that either on a hybrid basis, a full-time basis, or not at all, but certainly the hybrid basis is pretty important. And you know, that stronger preference for suburban living, I think, was seen more during COVID and is now normalising back again. But space, certainly very important. And the other thing we look at, because people tend to be either, you know, sentiment's so important, they're either for something or against something. But if we look at the house price performance during prior tightening cycles, it certainly has been very mixed. And higher interest rates clearly are a headwind. So they're a headwind now to housing prices, but we've gone through why some of that hasn't been seen on a more uniform basis. And if we have a look at this, house prices after the last interest rate hike, and bearing in mind the last interest rate hike we had in Australia was November last year, so November 2023, you know, we're 9 months after that. And whilst every cycle is different, you know, certainly it's performing more like this November 99 to August 2000 situation, where prices are up fairly strongly over that period of time. Now, some of that can be, you know, I guess brought back to what volumes or what levels of sales have been occurring, and look, that's been pretty healthy. So compared to this time last year, annual national sales estimates are up 8.6%, capital cities 10.2%, and the region's 5.8%. So interesting to see that slowing up again after, you know, COVID sort of expired. And again, if you look at, you know, the change in sales volumes, look at Sydney, up 13.7% there on the bottom left. The smaller capitals, so Perth, Adelaide, Brisbane, much less. Melbourne 12%, and Canberra's actually negative, but it's a slightly different market in Canberra, obviously. So, you know, that's pretty healthy. So turnover's still there, and as properties are coming onto the market, buyers are absorbing that. In fact, in most of these markets currently, the amount of monthly sales volume is greater than new listings coming on, although that's normalising in many markets. So as we always say, you know, this is as easy as pie, and that refers to population growth, infrastructure growth and employment growth. Look for those key underlying factors, and it should enable you to make an investment that has a happy outcome in the longer term. If you look at the various markets, and if you look at, you know, Sydney, which is clearly our largest residential property market, New South Wales has always had the most diversified economy, and it's, you know, the strongest economy, but the highest downside risks there, and we've been saying this for a while, due to affordability. However, as we've seen, that hasn't seemed to have stopped people being able to purchase in that market, and that ongoing demand for quality, I think, is being met by buyers who have cash, and that's what we're seeing. There's a large nuts what the banks are saying. You know, a lot of people are buying properties and actually not borrowing whatsoever. But quarterly house price growth has slowed further, and I think will continue to do so until we do see a reduction in interest rates. And immigration demand still remains very strong because, as you'll see afterwards, the amount of migrants coming to Sydney is certainly up there, the largest in the country. So if you look at the monthly, quarterly and annual changes, you can see that that's slowed up. Quarterly change, up 1.1%. So that is, I think, a consequence of the current interest rate settings to a large extent. Melbourne's an interesting one, always been Australia's second largest city. Immigration has boosted population growth there because, as you can see at the bottom there, Melbourne's always been very good at marketing itself to the overseas student market, and we've had a massive rebound there, and Melbourne's been the beneficiary of that. And it still remains very affordable in terms of capital city rental prices, but quarterly price growth is now negative, and it's been increasing actually over the last couple of months in terms of coming down, if you like. So I'll show you in a minute the latest figures, to end of July. It's come down 0.4%. So Melbourne is a sort of standout on the side of the downside. Perth, on the other hand, is a standout on the upside. It's had the highest annual capital growth, highest annual rental price increase. It's got slowing affordability now, and it's had high population growth. So all of those factors have worked really well for WA, particularly for the Perth market. And if you look at these numbers, and to the end of July, Perth's up 24.7%, I think, but they're very, very strong numbers, and they've caught up on some of that lag that's been in existence since, for the last decade. So quarterly growth of around 6.5%, very strong. And these are the latest figures from the end of July. As you can see there, Perth, leading the charge, but on the flip side of that, Melbourne is exhibiting a fair bit of weakness. Hobart, obviously, but that's for many different structural reasons. Melbourne is a bit of it's something that we're going to keep an eye on and see what happens there over the course of the next few months. So we often get this question, or not often, we get it all the time. Should I buy, this is in relation to an investment generally, should I buy a new property or an old one? And there's no correct answer to that, of course, because, as long as you buy good assets, they're probably both good assets. However, if you look at it from a realistic viewpoint, people are trying to generally buy either of those, but the old property, because they think they're going to be able to add some value to that and make some more money on it. So if you have the time and you have the skill set, then that's certainly a possibility. The only issue is, and what we've seen, especially in the last year or two, is, when you have everybody trying to do that, how are you going to be able to achieve that? And that's been the problem, where you've had lots of builders and developers and people trying to subdivide things, seeking to make that extra uplift. The price points have risen, and it's proven to be very, very difficult, because then they've had the problem of not being able to find people to actually carry out those renovations or rebuilds, etc. So great, let's say you've been in the construction business, building industry, and you have the skills, and you might be approaching retirement. That might be a really good way to go. But for most of our clients who, as I say, are very time poor and don't have the skill sets involved in the construction business, they prefer new property, because obviously the issue of repairs and maintenance is, if you're buying a high quality asset, very low. You get better tenants, it's easier to rent and to manage, and most of our clients obviously would like a no-touch situation in terms of that, but certainly a low-touch one is especially convenient. If you're an Australian expat, even more so, but if you're an Australian domestic resident, just the same. The less hassle, the better. What tax benefits can you get? And on old properties, that's generally speaking not very high. But if you're buying a high quality new dwelling, you can get very significant Division 43 and Division 40 tax benefits, which you can offset against either your personal exertion income if you're living and working in Australia, or if you're an Australian expat, against other income that you may have in Australia, being, other rental incomes is what we generally find clients. So how do we put it all together? What's the data telling us? Where should we be looking at? And this hasn't changed for a little while, and we'll go through why. And it has pointed to southeast Queensland, Brisbane being the capital of Queensland, having all of the hallmarks of being a good destination in terms of trying to buy something from an investment viewpoint and get some best bang for your buck. As values have increased, and Brisbane has certainly caught up in the last 12 months, in the last 4 quarters, but the valuation gap's even more substantial now between Sydney and Brisbane, and that's really because Sydney's had that massive run up and values started at a much higher price point there to start with. So Brisbane and southeast Queensland are seeing the strongest interstate migration. I've been saying this for a number of quarters now, and it continues on. It has a well-diversified economy. The work from home situation, we see it from clients, say from Sydney especially and Melbourne, that are now able to work on a hybrid basis, and they're saying, look, we prefer the lifestyle in Queensland, and we can actually do that. Our employers are happy with that. So we're seeing that also give some tailwinds to what's happening in the property markets there. As you can see there, that's been pretty strong. 3.7% over the last quarter to the end of July, so that's 16% annual increase, but starting from a much lower price point in the beginning. So if you have a look at that quarterly population growth, and these are again the latest numbers to the end of December, you can see WA and Queensland being the two standouts in terms of net interstate migration. Queensland, 31,500 compared to 10,700. So the actual nominal amount very much larger, and those people are going to live somewhere, and most of those people are going to buy something. Whereas if you have a look at the bottom there, if you look at net overseas migration, as I said, New South Wales, mainly Sydney, by far the biggest recipient of that cohort, a lot of those people are going to rent. So you've got to look at not just where is that population growth, but what is it comprised of, because that makes a massive difference. If you have a look at it there graphically, I think that shows very well what's happening. Queensland's had the greatest addition of interstate migration, and most of that's come from New South Wales, from Sydney again, and that is, for most people, a commercial decision. So they can sell their property in Sydney, buy a better property in Brisbane, and have money left over, spend less on private schooling, etc. And that's making that decision for them. So we see, and this is from MB.BS and Centre for Population Growth, that Brisbane's population is projected to grow to 3.2 million within the next 10 years. And the interesting point there, if you have a look, it's the population of Brisbane is going to overtake the rest of Queensland by 2027-28. It'd be the first time since 1978 that Greater Brisbane actually has a larger population than the rest of Queensland. So again, even each state within Australia is a large market, and there are so many markets within that it's important to look at these nuances and see what that may be able to assist you with in terms of making choices for what your actions are going to be. Then we look at granularity within those markets even further. So if you're looking at Brisbane, there's a chronic undersupply of apartments within 5 k's of the CBD, and as you can see there, average demand is 7,500 per annum, but it's running at more like 2,500 per annum. This year there's as you can see there, a substantial addition of about 2,000 apartments that will be at Queen's Wharf, so the new casino which will open later this year. But what you've got to remember is that all of those dwellings were actually pre-sold 3 years ago, so it's not necessarily bringing much to the market in terms of availability for new people to get a dwelling. And look, that we see that continuing. There's just not enough supply happening. Very few builders, high quality builders, still in the market doing residential developments. They're all doing, government work, infrastructure work where they have rise and fall contracts. They don't have to worry about, so much the increase in costs because they'll get paid more. And the other tailwind, of course, for southeast Queensland and Brisbane is the Olympic Games. Now, we're currently watching the Olympics in Paris, and brings that home a little bit more, I guess, rather than just thinking about it, because it's not just the Olympic event itself, it's all of the infrastructure that's being built prior to that. And that creates a lot of employment and a lot of other opportunities because it's increasing the amount of infrastructure that's in place, especially from a logistics viewpoint, traffic, but also from all the other amenities that go along with showcasing, a very large international event like the Olympics. So that's another tailwind that's going to remain with us for the next 8 years. There we had just a little bit of a discussion around the infrastructure that's being built in Brisbane, and if anyone's been there in the last year or so, they will have seen quite a lot of that nearing completion. As I said, I was there recently, and if you look at what's happening at Queen's Wharf, that's a massive development. Some of the green bridges that they're putting across the river to connect areas like, say, Howard Smith Wharves here in the CBD with Kangaroo Point. That's a massive difference. And all along the river here, you have these green bridges and they head up as the river flows, or upriver westwards. It's really quite a massive amount of development that's happening, and I see that being not just a tailwind as we go towards the Olympics and beyond, but really making it an even more livable place. So if we look at what is the value proposition of looking at all of this data and all these statistics and overlaying them with our 3.5 decades of experience, and it's probably to help people avoid the common investor mistakes that get made all of the time. We see this, whether it's from people, our professional clients or others in Australia or Australian expat clients. As I said, they're all very time poor. They do earn higher incomes, but they don't have much spare time, and they don't want to be spending that on either doing research or potentially having to deal with micromanagement issues on their investment portfolio. So one of the things we generally see is, if you look there, buying into a strong market, people, human nature, it is what it is, people always tend to buy things when I guess they're nearing a top potentially. So you see that in equities, in commodities, in property, in all sorts of things. Well, you should buy into a strong market of the future, and that's where the research and the data is so essential. It's something that we're constantly looking for, and as most of our clients know, over the years that's proven to be a pretty beneficial outcome for them. So any investment won't do, because people are time poor and they're busy, they sort of think, oh well, I'll just get something. You can't afford to ignore your point of difference, and that's something that that we look at very closely, and I'll show you why in a moment. There's no lack of information and research out there. However, we find even the people that do have the time to actually go through that say, well, look, I don't know what to do. The reason for that is that there is so much data, and a lot of it often is conflicting data, so it pulls you both ways, and you're then left in a situation where you don't know what to do. And lastly, but certainly not least importantly, waiting too long to invest. So I've seen this on a number of occasions where people say, look, I've been researching the market really closely, and I say, well, how long have you been doing that for? And quite often it's a period of years. And I say, well, what did you learn from that? And people tend to say, I should have done something then. So all of those things are important, and I come back to this here where any investment won't do, and I look at things like, say, a single commodity market like Port Hedland, driven by iron ore, and it has massive volatility. So at boom times, people can get huge rents, and it all looks fantastic. But then when things change, they can't find someone to rent that, and they may find that their capital value has dropped by 50 or 60%. So it's really important to bear those things in mind. And then if you look at other markets, we often look at, say, CBD markets, or look at Docklands or Surfers Paradise, and this has happened more so in times gone past, but still occurs, where people build these massive buildings of 1,000 apartments and very challenged floor plates, and they're small, and there's hundreds of them that are exactly the same. Your point of difference is gone. There are no unique attributes of those assets, so you're going to be challenged from a capital growth viewpoint and from a rental viewpoint if demand is weaker. So trying to tie all that together for people is really important, and it may sound easy, but it's not. So you put all that together, that population growth, what sort of population growth is it, who's moving there, the infrastructure growth, the employment growth, that all go hand in hand, the future sustainability of that, and then take it to the micro level. What are the unique attributes of your actual property that you want to look at, and will that strong economic activity continue in the longer term? So have a look at some of these. This is more, I suppose, a visual representation of the type of dwellings that we look for, not focusing on anything in particular. So, as I said, that's a representation, and we look at, especially now, if you're looking at new properties, we're looking to find high-end, high-quality townhomes, larger apartments that are in dwellings that sort of provide resort-style amenities to people, and obviously have the ease of connectivity and connection to all of the amenities that people these days seek, especially if they can afford to pay for it. And one of the ways we sort of put all that together is that a lot of this is done through actually, feet on the ground research, looking at sites, at locations from a before, during and after viewpoint. So if you have a look at this. I'm here in Brisbane, Queensland. We're in the suburb of Windsor, and behind me is a new site that's being built named Sayre. This is approximately 4 kilometres from the CBD, in close proximity to Royal Brisbane Hospital, and you have a lot of amenity around this area in terms of transport, in terms of restaurants, bars, places you can go to in Fortitude Valley, which are clearly not far removed. And it's interesting to note that
the skyline here reflects some of the urban development that's happening in the sort of inner middle ring of the Brisbane region. We always like to have a look at construction before and during and after when sites are getting built to give us a far better understanding of what our clients are going to see when they receive their finished product.
Right, so that's just sort of, I guess, a little bit of what goes on behind the scenes to give people an indication of how much time and effort we spend on trying to get those better outcomes for our clients. So if you look at the financial side and the commercial side of things, it's very important to see how much you need to pay. And people ask that. So as long as you know, as long as you can make an informed decision, it's something that's, generally speaking, quite doable. And this is the sort of normal situation. When I say normal, you've got to look at the cyclicality of interest rates, of rents, etc., etc. Normally speaking, for an Australian domestic client, tenant will pay about 73%, tax office about 21%, and you would pay about 6%. So what we tend to do for our clients is to look at all of the costs of acquisition and then the ongoing costs of ownership of a particular asset, and that obviously changes. This is a property investment analysis report, but it also changes quite distinctly if you're an Australian expat and you don't have Australian taxable income to offset some of the tax deductions, the depreciation items against. So if you can see there, the cost can be $388 or minus 12, and that shows people how that actually transpires, into cold hard cash. But Australian expats or non-residents are not, they're not disadvantaged to the point that they can't access these tax benefits because they can against either other Australian taxable income. So many of our clients have homes in Australia that may be unleveraged, or if there is a mortgage, it's not a large one, and they're getting a lot of rent for those properties, and they're paying obviously a lot of tax on that income. So that can actually be used to offset that, and they don't pay the tax. Or in other instances where a lot of people don't have that excess Australian taxable income, they simply save those tax credits and utilise them when they repatriate back to Australia. Or another possibility is if people don't repatriate back to Australia, they might utilise those when they sell a property and make a profit. So lots of different ways of handling and trying to get the most efficient tax outcome for our clients there, and make use of as much as is possible in terms of being able to build that property portfolio, because if you reduce your cost along the way, clearly it enables you to perhaps service the loan on another asset. And if you can see there, this is who pays for the costs over 10 years. Pretty straightforward if you're a resident or a non-resident. And again, if you look at the underlying numbers for that, then we can assist people, just make sure they understand exactly how much they need to pay or don't need to pay. And just sort of really to sum up, I suppose, we look at property, and I've got to remind people about this because it is, as I said, the most important growth asset on a macro level next to equities. And it's investment rather than speculation. So properties are chunky items. You can't just sell off a portion of it, equities or other financial instruments. You can. Also, the costs of buying and selling property are much higher. There are tax consequences that need to be considered. So that's why it's so important to either be able to do the research beforehand or have someone assist you with that, because you've really got to get yourself a good quality asset, as I said, that will stand that test of time longer term, and build wealth for you both through asset appreciation, so capital growth, and also income growth. And quality, obviously, in terms of maintaining that income growth without having, lags when you don't have a tenant. So if you look at that, we look at if you're at the bottom there, the highest level of sales, generally speaking, occurs from years 4 to 8. So people buy something and then they'll tend to sell it during that period. But if you look at the investment performance of those assets, as you can see, the longer you keep them, the better off, generally speaking, you will be. And those benefits become very, very significant over time. So you don't actually have to spin the wheels and do things all the time, buy and sell things and, incur costs and pay people money, etc. Because if you buy the right thing to start with, unless you're forced into selling it due to, perhaps health or family breakup or whatever, then you can just afford to keep those, and can generally help people utilise the increased equity within those assets to acquire further ones. So really important to look at that. You don't have to do much, you just have to do the right things. We've been doing it for a long time. We do have a very unique situation where we can give our clients within Australia, as non-medical or other professional clients, an 85% loan-to-value ratio without having to pay mortgage insurance. That's people who earn foreign income, and in Australia, people who don't get the benefit of potentially getting a 90% or 95% LVR that we can give to, say, our doctor clients, our medical clients. We make sure that you have the most efficient tax outcome. We've helped a lot of people, and we try and find properties that do have those unique points of difference that will pretty much underpin a lot of longer term outcome, for that investment as you go forward. So we look at things in a process driven way. Obviously, most important thing is first of all to understand what people are looking for. So these days it's pretty simple to arrange a Zoom meeting to organise that, look at people's personal situation at that point, and then go further on from that, see what fits their current situation, or if they have any particular nuances they want to overlay on this, and see what the best way to assist those people may be going forward. By all means, if you need any assistance with your own situation, then please contact us, email us or call us, and we'll have somebody come back to you and arrange for a Zoom consultation. So thanks for joining us. I hope you found it somewhat enlightening and helpful, and take some of the confusion out of being able to make some reasonable decisions with both your property needs and finance needs going forward.